Brent crude futures saw a significant decline of over 5%, approaching $86 per barrel on Wednesday. This marked their lowest point since September 1st. This drop was in response to the latest EIA report, which indicated a weakening demand for gasoline, and news suggesting that Russia might soon lift its ban on diesel. In the meantime, OPEC Plus maintained its current oil output policy, aligning with the decisions of Saudi Arabia and Russia to extend voluntary supply cuts until the end of the year. In the United States, EIA data revealed a decrease of 2.224 million barrels in crude stocks, bringing them to 414.1 million barrels. However, there was an unexpected rise in stocks at Cushing, Oklahoma, which hadn't occurred in the past 8 weeks. Additionally, gasoline stocks experienced a significant increase of 6.481 million barrels, surpassing expectations that predicted a rise of only 161,000 barrels. Natural gas. U.S. natural gas futures surged beyond the $3 per million British thermal units threshold, driven by factors such as reduced domestic gas production and increased exports. October witnessed a decline in gas output, dropping from 102.9 BCFD in September to 102.4 BCFD. This decline followed a record high of 103.1 BCFD in August. Furthermore, the U.S. was anticipating warmer than usual weather conditions extending until October 19. In addition to these factors, natural gas exports to Mexico were on the rise, with expectations of further growth upon the commencement of New Fortress Energy's liquefied natural gas (LNG) plant exports. However, the overall volume of natural gas supplied to the 7 major U.S. LNG export plants remained relatively steady in October, falling short of the record levels witnessed in April. It's noteworthy that Cove Point, which temporarily halted operations around September 20th, was anticipated to resume production within the next week or so. Gold. Gold prices remained below the $1,820 per ounce mark on Wednesday, marking their lowest levels in 7 months. This decline was attributed to the strength of the U.S. dollar and elevated bond yields. Investors were carefully analyzing recent U.S. economic data. The U.S. dollar gained strength, reaching approximately 10-month highs against a basket of other currencies, while the 10-year U.S. yield surged to its highest levels since 2007. These trends were driven by increasing market expectations that the Federal Reserve would maintain higher interest rates for an extended period, consequently raising the opportunity cost of holding non-yielding gold. Despite the resilience displayed by the U.S. private sector, as indicated by the service's ISM PMI figures and manufacturer surveys, job data presented a mixed picture. The JOLTS report indicated a rise in job openings to 9.61 million, whereas the ADP report revealed the smallest addition of jobs by U.S. private employers since January 2021. Traders were now eagerly awaiting the more comprehensive U.S. monthly jobs report on Friday and closely monitoring statements from Fed officials. Silver. Silver prices fell to approximately $21 per ounce, marking their lowest point in over 6 months. This decline was influenced by concerns related to rising interest rates, higher bond yields, and a stronger U.S. dollar. In its most recent meeting, the Federal Reserve signaled the likelihood of one more interest rate hike in 2023 and a slower pace of monetary easing in 2024. This confirmation reinforced expectations that interest rates would remain elevated for an extended period, thereby increasing the opportunity cost of holding non-yielding silver. Additionally, strong U.S. ISM manufacturing and services PMIs supported the argument for a hawkish stance from the regulator. Investors were keenly awaiting the key monthly U.S. jobs report on Friday for insights into the Fed's monetary policy path. Despite these challenges, silver prices continued to find support from tight supply, developments in solar panel technologies requiring higher conduction capabilities, and optimism regarding an economic recovery in China. Aluminium. Aluminium futures gradually declined towards the $2,300 per ton threshold after reaching a 5-month high of $2,347 on September 29. This decline was in sync with the overall trend in other base metals, influenced by the Federal Reserve's hawkish stance, which bolstered the US dollar and dampened industrial sentiment. However, the downturn was limited due to concerns regarding the supply of aluminium. China, the world's leading aluminium producer, responsible for over half of the global output, decided to halt the expansion of production capacity beyond the current limit of 45 million tons. Beijing's objective was to prevent oversupply and the heightened energy consumption associated with outdated and inefficient infrastructure. Concurrently, Indonesia's ban on bauxite exports, the primary commercial ore for aluminium production, posed a risk to the supply. These developments were evident in a notable 13% week-on-week reduction in deliverable aluminium stocks at the Shanghai Futures Exchange during the final week of September. Zinc. Zinc prices remained above the $2,550 per ton mark, not straying far from the over 4-month high reached on September 29. This was driven by renewed optimism regarding China's economic recovery and the anticipation of reduced production. Small and medium-sized zinc mines, particularly in Europe and Australia, continued to grapple with profitability challenges due to high operating costs. Recent data revealed that China imported 76,800 metric tons of zinc in July, marking the highest monthly total since April 2019. Additionally, China's official manufacturing PMI climbed to 50.2 in August, signifying the sector's first expansion since March. In terms of supply, China's domestic output of refined zinc had increased for the year, but the market remained affected by diminishing inventory levels and constrained time spreads. Further upward momentum for the metal was limited due to concerns about the extended duration of elevated interest rates. Copper. Copper futures trended lower, approaching $3.60 per pound in October, hovering near their lowest point in 4 months. This decline was influenced by the Federal Reserve's hawkish outlook, which strengthened the US dollar and reduced demand for industrial inputs. Optimistic manufacturing PMI data from the US provided further support for the idea that borrowing costs would remain restrictive for a more extended period. This supported the DXY and led to 10-year Treasury yields reaching 16-year highs, affecting the global industrial activity outlook. Nevertheless, concerns about potential shortages in the copper market limited the extent of the decline. Reports from S&P Global and the EIA projected that copper demand would double from current levels by 2035, falling short of the International Copper Association's forecast of a 26% supply increase. In the short term, output from Chilean state-owned Codelco declined by 14% in the first half of the year, exacerbating the 7% decline observed in 2022. Bitcoin. The Bitcoin US dollar trading pair was recorded at 27,786 on Wednesday, October 4th, marking an increase of 391 points or 1.43% compared to the previous trading session. Over the past 4 weeks, Bitcoin had gained 8.1% in value. Looking back over the last 12 months, its price had risen by 39%. Brent crude futures saw a significant decline of over 5%.